Morning all from chilly Johannesburg, and welcome to the first Super Investment Feedback Session of 2025. I am Zwasho Niwa, representing Sanlam Umbrella Solutions. And on the agenda today, we have an economic overview panel discussion, which is led by Solly, after which Solly and Paul will take us through the fund performance update, and we should be done at about 12 p.m. Next slide. I think as I reflect on the past year, we had a session earlier with our intermediaries on Wednesday, earlier this week. I'm definitely reminded of the profound power of partnership and driving meaningful progress, especially within South Africa's dynamic and evolving landscape. Some of us would have watched the president last night and I think now fully appreciate how members' investments and replacement ratios can be affected at the back of some of these political discussions that are currently taking place. However, notwithstanding the recent market volatility, which Solly and Paul will talk to, from our side, your continued support and collaboration have been instrumental in enabling us to deliver exceptional value to our members and empower them to navigate an increasingly complex financial future with confidence. We're deeply grateful for your unwavering belief in Sanlam Umbrella Fund. And thanks to your trust and commitment, we've not only sustained our momentum, but have now reached assets under management of just under 125 billion. Part of this is driven by the exceptional performance of our default portfolios, which Solly and Paul will talk to us later in the presentation. But I think from our side as Sanlam Umbrella Solutions, this just reaffirms our position as the fastest growing umbrella fund in the industry. And thank you as supporters of this fund for walking this journey with us. And then quickly, just from a fund update perspective, I just wanted to confirm that the changes which were previously communicated with regards to the Sanlam Blue Lifestyle strategy and the SIM Balanced Fund were implemented in November 2024, and this has been concluded. And just as a reminder for some of you that might have missed the note or are not sure as to what it is that I'm talking about, the SIM Balanced Fund was terminated and the portfolio was replaced with a new portfolio called the Sanlam Multi-Asset Growth Fund within the Sanlam Blue Life Stage accumulation phase. And the SIM Balanced Fund in the member investment choice range of portfolios was also replaced with the Sanlam Multi-Asset Growth Fund. Now, another update that I did want to share with you is that we're currently reviewing the MIC menu, so that's your member investment choice menu. And should any changes be agreed to by the Sanlam Umbrella Fund Investment Committee, such will be communicated to yourselves post the upcoming Sanlam Umbrella Fund Investment Committee meeting in June. So once again, on behalf of Sanlam Corporate, thank you, and we look forward to continuing this journey of mutual growth and success. Enjoy the session, and hopefully I'll see most of you at our upcoming Sanlam Benchmark Symposium. Over to you, Solly.
Thank you very much, Nzwa, with that introduction and also the updates. Good morning, everyone. As per the usual, we will start with an economic overview just to give context into the environment where the investment returns have been earned by members' retirement savings. And to help us with this, we'll have a panel discussions from our investment professionals that are well known in the industry. So we have Paul Wilson, who's the Chief Investment Officer of the Sanlam Investments Multi-Manager, so one of the largest multi-managers in the country. And then Kamenel, who's Head of Multi-Asset at Terebinth Capital. So Kamen will give us, just their asset manager views. They often at the core phase of what's happening. And Kamen is an economist by profession, so we value her views. And also Alicia Naika, who's a seasoned senior investment consultant, often advising pension funds and also some of the participating employers. So welcome, Paul, Kamen, and Alicia. Just to kick off the discussions, I think it's worthwhile looking at the investment returns from the markets. So the month of April was a very positive month from South African asset classes perspective. So local equities earning 4.3% over that month, and offshore equities as well earning 2.1% during that month. So if somebody was coming from Mars on the 1 of April, on 1 May, and looking at these returns, they will think that, nothing was happening in April. It was just smooth sailing. And I just want to kick off the discussions with you, Carmen. In terms of what's been happening in April, what are some of the developments that happened, and how did we end up, with a positive return for the month?
Yeah, so I think the big story in April really was the Trump tariff announcements. So Liberation Day, as he called it, on the 2nd of April. That did give rise to a significant risk-off event, very sharp declines in global equity markets, and a significant increase in equity market volatility. And that was because he significantly escalated tariffs following what he had already announced in February, and then also implemented wide-ranging reciprocal tariffs on a whole bunch of countries based on a very arbitrary sort of formula, with our neighbor Lesotho, I think, now sits at a 50% tariff for exports to the US. South Africa is facing a 30% tariff. But there was a lot of whiplash in that very soon after that announcement, a 90-day truce was announced. And then also there was engagement with China. So initially the Chinese-US tariff war escalated, with both putting tariffs in excess of 100%, but that has de-escalated very quickly. And then you saw this whipsaw in markets being down 10 to 15%, and then rebounding fully and then some with that. So it's really this policy-induced volatility that, as you say, sort of masked what happened intra-month.
Just a follow-up question on Carmen, for you, Carmen. Going forward, do you think that this uncertainty is gone, or we just, should we brace ourselves for something bigger to come?
Yeah, so we're now sort of forced to make investment decisions on whatever Trump is going to tweet when he wakes up, or put on sort of his social media platform. I do think we have to acknowledge that, we are busy with the regime shift. So things have definitely changed. Things will not go back to where they were, let's say, middle 2024, but they certainly won't be as bad as they were announced on the 2nd of April. I think the markets generally and investors have been very surprised by, one, how far the tariffs have been rolled back, so not completely eliminated, but they have been significantly rolled back, certainly between China and the US, and then how quickly that has actually happened. I do think we need to learn to live with the uncertainty, and it will spike from time to time. So, the reform that Trump wants to implement, that has not gone away. So there will be other measures that come through, and we don't know when these 90-day truces or pauses end, what will come through. But I think the shock that the markets experienced in April certainly maybe gave the Trump administration a bit of food for thought about how aggressive to be on this. So uncertainty has receded, but I don't think it'll go away.
Okay, thanks, Carmen. Paul, I just want us to bring this home now. So these tariffs and also the policy and the trade policy uncertainty internationally, our understanding is that this will ultimately be felt in the South African economy. What's your view on how these tariffs uncertainties have affected our local economy?
Well, I think Carmen's correct in that there's still quite a lot of uncertainty, and it depends which side of bed Trump wakes up on. At this point in time, we're on the wrong side of the bed when Trump wakes up. And so, we've got to try and figure out how to make sure that we can partner with America. It was interesting watching last night's conversation, I guess. I'm hopeful that from that conversation there can be some sort of compromise found, and that we can move on, because America is our second biggest trade partner and our biggest single investor from a foreign direct investment point of view. So the reality is, if we get cut off from the US, either in the form of sanctions or very high tariffs, it'll be negative for our economy. We're an economy that struggles to grow jobs and to grow the economy at faster than sort of 1.5%. Already this year, I think the economic growth forecast was lowered from sort of 1.92 in the start of the year to about 1 now, and potentially it's going to be even lower than that. So we're a country that's really struggling to get off the ground from an economic growth perspective, and there's many reasons for that, which we don't really have time to get into now. But I think this uncertainty doesn't help us. There's not really a scenario where at this stage all this uncertainty is good for us. I suppose the one area that we can potentially look at is, maybe there's some countries that feel sorry that South Africa's caught in the crossfire and look to support us in other ways. I mean, I think Europe has said one or two nice things, but it's one thing to say one or two nice things. It's another thing to actually put money on the table and to actually do some sort of trade deal. So we've got to box smart. I think we've got to look very much after ourselves. And I think at least the delegation that was there last night tried to strike up a very conciliatory tone and didn't go in there guns blazing. I think they went in quite humble. And it was certainly nice to see across the spectrum, whether it was sports stars, politicians, opposition parties, and rich billionaires, that they were all sort of singing off a very similar hymn sheet for the most part of the conversation. So, yeah, not positive for us, Solly, at the moment. We're in the eye of Sauron at the moment, I guess, if you want to use the Lord of the Rings analogy, or in the storm from the previous page. And we've got to ride that through, but hopefully we can navigate it with some deft diplomacy and, not lose jobs as a result of this trade tariff uncertainty, and potentially strengthen relations with a country like the US whilst maintaining our relations in other parts of the world.
All right. Thanks, Paul, for helping us think about, how the external factors, international factors are affecting South Africa and also the South African growth. There's also belief that we have our own internal issues, and I'm looking at Alicia now, looking at the South Africa specific factors that have impact on the economy. And I'm going to just ask Alicia to talk about the government of national unity in terms of where we are. I think the formation of that government brought a lot of positive sentiment. So Alicia, where are we right now in your view? How can you help us think about the stability of the GNU?
So thanks, Ollie, for the question. If we take it back a step to the positive sentiment that came out of the formation of the Government of National Unity post-elections in May last year, we saw how markets, swung to the upside, and all of the positive sentiment around the formation of a Government of National Unity. We saw the first hurdles come through at the first budget 1.0 earlier this year, where there was rigorous debate around the VAT hike from 15% up to 2 percentage points. And we've seen the positives coming out of that rigorous debate between the parties that form the Government of National Unity for us, as that VAT hike was negotiated down even to 50 basis point hikes over 2 years. And now with the potential passing of Budget 3.0 yesterday coming through. Not to say it's all positive and to try and keep everything upbeat, but there was also negative sentiment around it, and the potential threat to the dissolution of the Government of National Unity should negotiations not have proceeded forward with a forward momentum through to Budget 3.0. But it's positive to see that they found a way to work forward, and that it brings back some stability. The thing for us to keep an eye on is how easily market sentiment sways, and as Carmen said, the whiplash of the events as we go back and forth and through negotiations of this going forward. At this point, it was very positive to see Minister John Steenhuisen joining Cyril Ramaphosa at the White House yesterday, and all of them echoing the same sentiments about South Africa and about the growth of South Africa, and being on the same page about wanting to progress our beautiful country. So at this point, I think we're seeing some stability come through, especially post the budget speech 3.0 yesterday.
Yeah, so I want to just hang on the working together, being on the same page, the government, etc. And I'm looking at Carmen here. Looking at another development last night, the budget. So we had the budget 1.0, 2.0, 3.0, Is this it, or we could expect a 4.0? And what are the takeaways from last night?
Yeah, so it is sort of new territory for us in South Africa, not having that certainty, given that you have to have a whole bunch of parties agree. But I do think that enough was done for this to be the final budget in terms of the 2025 process. I do think broadly it was market friendly. At the margin, it was actually a positive surprise versus many analysts' forecasts. Yes, the sort of deficit to GDP ratio and the debt to GDP ratio are now slightly worse, but you still had sort of a spending restraint coming through. Obviously, the fact that there is now no VAT hike, government or Treasury had to make a plan getting those revenues elsewhere. So there was a slight revenue overrun in the prior fiscal year, which sort of provides a bit of breathing room. But we did see a fuel levy increase, which we haven't had in a while. I suppose it does lead to some consumer strain, but the oil price at least is very low. So maybe there's a bit of capacity there. And then obviously bracket creep might also then be a bit of a strain. So it's not necessarily an outright consumer-friendly budget, but the market certainly liked it in the sense that we've had a decent bond market rally post the earlier GNU fears. And then I think what we need to factor in is just that if there are, as Paul said, going to be further downward revisions to GDP growth and inflation stays low, then certainly we're not out of the woods in terms of our fiscal position. So there will still have to be a lot of work done to ensure ongoing spending restraint. And then obviously in terms of the SA Revenue Service, that there are ongoing efficiency gains there so that we can continue to avoid having outright tax increases. So I think broadly neutral now for markets, and I think they're neutral if we look at what the credit rating agencies have said about the budget.
So, Carmen, whilst you still have stage, I mean, a couple of commitments were made in terms of maintaining fiscal prudence. So just being prudent in how the government is spending money. So they make a couple of statements, just trying to make sure that our spending doesn't go out of control. Your view in terms of execution, do you think that it's something that we can see?
Look, sort of execution or implementation risk is always very high because even though, spending is what Treasury in theory controls, a lot of it comes down to the departments and how they then choose to spend their money. And often what you see is where there are spending overruns, let's say on sort of generous wage agreements, what Treasury then would do is force these departments to balance their books on their own and then ensure that there are spending cuts elsewhere. Implementation risk is large. So let's at least acknowledge that. I think that's part of the fiscal risk. But they did publish a paper or a document on what they call the fiscal anchor. So you could sort of think about it as a fiscal rule. So we are not new to fiscal rules. We for many years had a nominal expenditure ceiling, which did work quite well in sort of containing spending growth. Post-COVID, we did break the ceiling or break the rule more often than not, which again, part of that is linked to sort of Eskom, part of that is linked to the massive economic fallout that COVID had. But at least, we continue to move in the right direction. And we'll have to see what comes out of this whole debate about the fiscal anchor. Currently, they're using a primary surplus as the target. So the primary surplus is your spending excluding interest payments versus your revenue then, and that is in a surplus. So I think that is also very positive. So while it has been a very difficult time in terms of agreeing on things, there is a lot of commitment, but I do think we need to start seeing it follow through. And I think what is going to challenge that is that the macro backdrop is going to become a bit less friendly. So that will then require a lot more political will.
Okay, so that's just on the expenditure side of the budget. And there's also the revenue side, which is predominantly the tax receipts. And the growth of that is dependent on the growth of our economy. And I'm looking at Paul to say, look, I just want us to focus on infrastructure that has been painted as one of the growth enablers. I mean, the government saying that expenditure on that is expected to be just over R1 trillion in the medium term. Just your view, Paul, in terms of how can this be achieved, just to ensure maximum benefit for economic growth?
Yeah, I mean, look, the fact that they want to spend money on infrastructure, I think, is a positive thing. You can't really grow your economy without sufficient infrastructure. I think we've seen that. Eskom and load shedding is a prime example. Transnet and the rail infrastructure is another one, where we haven't been able to get goods to ports, or we've had businesses being shut down because they don't have any electricity to run. So infrastructure is critically important to economic growth and the potential for economic growth. But it's not the only thing that's going to bring it. So there's two things that I want to mention here. One is we've got a very bad track record at sending money where it's actually targeted to go. I mean, education is a prime example where we've got as a percentage of GDP, one of the largest spends in the education sector, but the money never gets to where it needs to go to because it gets funneled away into various areas. So a R1 trillion infrastructure spend sounds good, but I have my reservations around how much of that R1 trillion actually ends up building infrastructure. So that's the one concern I think we've got. And the other one is you still need to create a favorable policy environment to encourage businesses to invest. So even if you've got excess capacity, and I'll put that in inverted commas, from a infrastructure perspective, if you don't create favorable policy framework and environment, you're still going to get businesses that will probably not want to invest necessarily unless they have some level of certainty around the fact that, for example, their IP won't get stolen, their property won't get confiscated. I'm thinking basic things like that. They won't be told who they can and can't hire, and all those kinds of things that we've heard many times over are challenges for businesses operating in South Africa. And I think there was I can't remember which organization did the survey, but South Africa was one of the countries that rated the worst in terms of ease of doing business. I can't remember which survey it was. So we need to not only spend money and time on infrastructure, which is critically important for our economy. I mean, anyone who lives in Joburg will understand that from a water point of view. There's regular blackouts of water. You can't really do much without infrastructure, but at the same time, we can't just rely on infrastructure as a silver bullet. We actually need to spend time fixing the policy frameworks, encouraging businesses to invest, and looking like a desirable investment destination, because at the end of the day, you've got to encourage those people with big checkbooks to come and invest in the country, and otherwise we're not going to get our economic growth. But at this stage, infrastructure is a critical element, because even if we had people that wanted to invest, we don't have, for example, the electricity network to handle it and the rail network that can operate efficiently. So, yeah, it's a multi-factor issue, but it's certainly a step in the right direction. I mean, we desperately need better infrastructure. So it's a positive in my book, but there remain concerns around whether the money gets there and what the framework environment looks like at the end of the day.
Thanks, Paul. I just want to lean on Alicia's wisdom. When you're talking to clients, when you're talking to retirement fund members, the board of trustees, we've painted a bleak picture in terms of the global uncertainty. Here at home in South Africa, there is opportunities such as infrastructure, but Paul says that's not a given. That's not a silver bullet. How do you talk to your clients about future expected returns? And I just have a graph on the screen that shows in 2002, there was a dot-com bubble, 2008, global financial crisis, the sell-off, 2020 COVID-related market losses. Should members receive negative returns, are we still likely to see markets recover? And yeah, just want to get into your head in terms of the discussions that you have with your clients around these.
Yeah, so I think April was a great example of patience is required. As you said, if you look at the numbers that we ended up with across the markets in April, the board was green. The first slide you put up on the indices was green across the board. But going through the events that happened in April, you wouldn't have assumed that we would end up in the green for the month of it. And that's exactly the sentiment we intend to carry, and we do carry throughout investments and to our trustees and down to members. Is it's time in the market that's more important than trying to time the market. So we'll go through these whiplashes. We've experienced it in the past, like the chart you have on the screen. We've been through the great financial crisis. We've come through that steep dip of 2020, and with ongoing wars across the world and the geopolitical risk that we're seeing, we're still seeing positive returns come out of markets. So the sentiment that I'm getting across today's panel is the uncertainty is here. It is here to stay for some time, and we've got to learn to be comfortable with it. And remember that we're long-term investors. It's time in the market is the sentiment that will get us through. And over the long term, the markets, as we can see, have recovered in the past.
Thanks, Alicia. I think that helps investors calm down, and also the role that you as an advisor plays and say, guys, look at the long term. Now, I just want to go to Carmen and Paul, and I will start with Carmen. I was just deciding in terms of who I start with. Where are these returns going to come from? Alicia says, look at the long term. We will weather the storm. So, Carmen, do you have any crystal ball you can use to tell us where these long-term investment returns are going to come from?
Yeah, no, I wish I had a crystal ball. I think sort of our view at Terebinth is that, as I mentioned before, things have changed. We're undergoing a regime shift, and part of that is, let's call it global fragmentation. And I think what's going to happen is that whereas we've come out of 15 years where basically it was all about the US and the S&P 500, now we're entering a period when I think diversification is actually going to be rewarded again. So if you think diversification across asset classes, across markets, across geographies, I think that'll be important. Obviously, what you want to do, and as a sort of in terms of prudent investment, is have a blend between your growth assets and your income assets. So that will obviously be linked to your life cycle stage, your investment horizon. The longer you are, the more you can have growth assets versus the shorter to retirement. You can have a little bit of growth, but more the safety of income. If we think just domestically, our bond yields are still relatively elevated. So the 10 years sitting at about 10.5%. So that's what you can sort of assume then for a very long run bond market return. That also can sort of absorb a bit of capital market volatility. And then sort of estimates for long run equity returns probably could be between, let's say, 12 and 14%. A lot of that will depend on the reforms we implement now actually paying off in terms of the gains long run. So that's just looking at the local market. Then if we correct that the Reserve Bank will continue to be a conservative orthodox inflation targeter, it does mean that in the long run, you can get relatively healthy real returns from our domestic markets.
Okay, thanks, Carmen. Paul, anything you want to add to what Carmen has said, just helping calm investors' fears and also looking at where the long-term returns are likely to come from?
I think Carmen covered it pretty well. The one thing we always just remember is that over the long term, markets will go up more than they go down. So what Alicia said in terms of spending time in the market, most investors, members in an umbrella fund have a fairly long-term investment horizon. And it's important just to remember that these markets, just like this chart on the screen, there've been some pretty bad negative periods, but if you look at the overall trend, it's sharply increasing. So I guess the challenge is the world. There's always going to be noise. There's always going to be negative events occurring. But companies and businesses press on, and they continue to generate earnings. again, from a South African investor point of view, 65 to 70% of our company's earnings are actually generated outside of South Africa. So the irony is that even though the last 5 years has been pretty bleak for South African economic growth, the SA market has done pretty well relative to global markets, but it's because the company's underlying earnings have come from various other places, like a Tencent in China, or a Richemont, or an Anglo-American, or whatever the case might be, where some of their mines are not based in South Africa. So the equity market in South Africa is actually a fairly good hedge protection against, I suppose, calamity in South Africa from that perspective. But we know markets go up more than they go down, and rather be invested for a long term and don't worry too much about the short, sharp corrections, because you'll end up making the money back if you just leave it there. So and that would be the only other thing I tend to add is try and focus on the long term and leave out the short-term noise, because Trump's not going to be here in 5 years' time. We don't know who will be here in 5 years' time, but it won't be him, because he's only allowed to run twice, no matter what he says about running for a third time. So I can't see that happening. So yeah, I think the world will be different in 5 or 10 years' time, and we'll have to have moved on with that. So yeah, the markets will continue on their volatile but mostly upward ride, I think, for the long term.
Thank you very much, Paul. I think with that, I would like to conclude the panel discussion. Hopefully this has painted a context in which members and the returns on their retirement fund savings. I think an important expression that I took from Paul now, in pursuit of simplifying what we always say on investments, is that markets in the long term go up more than they go down. I think that's simple enough, Paul, to leave us with that. And with that, I'd like to thank Carmen, Alicia, and Paul for your wisdom, for sharing us your views, short, medium, and long term.
Thank you.
Right. We will now move to the investment performance of the portfolios. Paul will be taking us through the defaults, and in terms of the life stage strategies, I will then come back again and give investment performance feedback on the protection strategies. Over to you, Paul.
Thanks, Solly, and thanks, everyone. I think Solly spoke a little bit about the returns that we've experienced in the markets the last while, and they've been pretty robust and pretty strong, particularly post-COVID. And actually, this 5-year number excludes the COVID crash. And you can see post-COVID, for example, the South African equity markets delivered 17% and actually outperformed the global equity market. So it's not something, again, that we would naturally have assumed, given the weak economic growth that we've experienced in South Africa post-COVID compared to the rest of the world. But as I mentioned earlier, because our companies make a lot of their money outside of South Africa, we've actually done well as the global economy picked up post-COVID environment. And risk assets have been the place to be over the last sort of 1 year, 3 years, and 5 years. So you've had some fairly decent returns out of asset classes, mostly risk asset classes. Certain asset classes, you can see, for example, global bonds, whilst they provide protection in very risk-off periods, actually over the last 5 years have delivered a negative return. So again, it's not as if all asset classes have done well, but your aggressive equity and property type asset classes, as you can see, South African property being one of the top performing asset classes that you've had over the last 5 years. And year to date, a similar picture from an SA point of view. It's been a very strong South African equity market, and actually, again, outperforming global equities fairly substantially. That's reversed a little bit in May. We've seen global equities actually run fairly hard in May, but the rand's also strengthened. So from a South African investor point of view, again, South African equities up in May. So it's been a very strong investment performance period in markets. And I think that you'll see it when you see the performance of the funds. It means that over the last 1, 3, and 5 years, funds have been able to generate far in excess of inflation returns. But we know that these types of periods are temporary, and you end up getting good and bad periods. But it's despite all the noise, the COVID noise, the Trump first, the January 6th thing when he lost and Biden came in. We've had the Russia-Ukraine war. We've had the Israel-Palestine conflict. We've had South Africa, go through an election where the ANC lost majority. We've had the KwaZulu-Natal riots. We've had the GNU, and now Trump again with tariffs. And in that 5-year period, risk assets have done very well. So it's not always the noise that matters, but what's happening underlying that matters. So just from the fund strategies and the defaults, there's 4 life stage options within the Sanlam umbrella fund. As you can see here, the life stage strategy, the passive life stage strategy, the blue life stage strategy, and the wealth creation life stage strategy, as well as the 3 protection options in the volatility protection, stable, secure strategy, and the Sanlam stable strategy. So you can select from a life stage option which one you would like to use from a trustee approved default perspective, as well as the protection option. The life stage strategy and the wealth creation strategy are multi-managed. The passive is obviously, as it says, the passive strategy, and the Sanlam Blue is a combination between Sanlam SPW as well as a more Sanlam orientated strategy. From a life stage strategy point of view, whichever one of those defaults you end up selecting, as you can see the 4 down here, you go into that accumulation phase and you in 100% of one of these portfolios, whichever you select, until you reach the period where you start getting closer to retirement. There's a period then of 6 years where they do 50 monthly switches to try and gradually get you down to the place where you end up in a capital protection preservation portfolio. Again, I think this is one of the smarter ways of trying to handle specific risk, like, for example, you happen to turn 55 on a certain date and then you get swapped from a very aggressive portfolio to a very conservative portfolio, and then you miss out on a lot of market movement. So as one of my mentors used to say, you don't die when you reach retirement. So you still have a very long-term investment horizon post-retirement. So you don't necessarily want to be switching out of your risk assets too soon. I like the approach that the umbrella fund takes in terms of making sure that you've got 50 monthly switches that take you from that accumulation phase into the preservation phase. From a performance point of view, as you can see over the last 1, 5 and 5 years, you've had some pretty strong performance relative to inflation. Remember, inflation's averaged about 5.5 over the last 5-year period. And so you've had returns well in excess of inflation. For the most part, from an accumulation portfolio point of view, this is relative to its strategic asset allocation over the last 1 year. It's slightly outperformed it. Same thing over the last 3 years and 5 years. Year to date, a little bit under. The Satrix strategy, the passive enhanced balance tracker, has actually managed to keep pace with its underlying benchmark, and over 5 years beaten it slightly, and over 10 years the same thing. There is tactical asset allocation that occurs in that portfolio, and that's what's adding the value, because remember, from a passive perspective, you're usually trying to track the underlying index. So the value add is through the tactical asset allocation. The blue strategy is the one that's recently been changed. So it's the one that was a 50-50 split. Used to be between SPW balanced and SIM balanced. The SIM balanced component has been shifted out and been replaced by a strategy called Sanlam multi-asset growth. That change occurred in November last year. And so year to date, you can actually see some of the benefits occurring there to the end of March, where the blue portfolio is outperforming its benchmark. Some of the longer term numbers, though, need to be improved, and that's hopefully what will happen as time progresses. And then the wealth creation portfolios had a slightly weaker last 12 months, but long term remains one of the better performing portfolios that's available from a default perspective. So you can see over 3 years and 5 years actually has very high returns relative to some of the other default strategies. So whilst it's had a weak 12-month period, I think from the multi-manager perspective, because we manage that portfolio, we're comfortable that the managers and strategies underlying that are robust and solid. And so we're quite comfortable. We know that sometimes things will take short-term underperformance, but in general, very strong performance over the last 1, 3, and 5 years relative to inflation and relative to benchmarks, certainly in the case of the accumulation, the enhanced balance tracker, as well as the wealth creation portfolio over 5 years, all outperforming their stated objectives. If you look at these defaults relative to other large umbrella fund strategy defaults, and we focus a little bit on the 1, 3, and 5 years, over the last 12 months, the accumulation portfolio is actually the top performing out of all the default strategies on the other umbrella funds with multi-manager portfolios. Over the last 3 years, the wealth creation and accumulation portfolios are the top 2. And over 5 years, the wealth creation and accumulation portfolio are in the top 3. So it's very strong and consistent performance from the default strategies that are multi-managed relative to the other multi-manager default strategies within the various umbrella funds. So I think, again, partnering with the Sanlam umbrella fund and the default options that the trustees have selected, I think it's been good for members because for the majority of the time, you've ended up near the top of the pile compared to other default umbrella fund strategies. If you look at it based on a slightly wider, from a passive perspective, you can see the Satric Enhanced Balance Tracker, again, very consistently close to the top of the pile and certainly beating the majority of the other tracker portfolios that are out there. So again, from a default member point of view, when comparing it to other large umbrella funds default strategies, again, I think a very good option. From a member choice portfolio perspective, remember there's quite a lot of member choices out there. So in the more moderate aggressive space, we've got a fair number of options available for members to select if they don't want to select one of the default options. Whereas in the moderate and conservative space, there are far fewer options to select from. Again, that makes sense because the majority of members' assets will be in the accumulation phase, and so they need a high exposure to risk assets. So it makes sense that there's a bigger menu of options available in the moderate aggressive space. If you look at sort of the moderately aggressive portfolios and what's performed well and what hasn't, so over the last 12 months, a manager like Camissa has done pretty well. PSG and Truffle have done well. And then the Sanlam accumulation portfolio and the SMM Select Balanced Fund round out the top 5 of the portfolios. At the other end of the spectrum, the Sharia portfolios have struggled. And then the Sanlam Living Planet Fund, which again has fairly strict restrictions in terms of what it can invest in, because what it's trying to do is give back a fairly decent return, but at less than half the carbon emissions of the index. So it means there's very steep restriction on the types of mining funds, equity that it can hold and the like. And so there's quite a number of restrictions that the fund has. And obviously things like mines and gold miners have done pretty well this last while, and it doesn't hold some of those structures. Longer term performance for a fund like that is also suffering as a result of some of these ESG related issues which have been taking place post-COVID. There's been very much a shift back towards more coal and coal-fired power stations and the like, which is why it ends up at the bottom. Over the last 3 years and 5 years, though, you can see the Sanlam Multi-Asset Growth Fund very high up, and Sanlam Wealth Creation, Select Balanced Portfolios, again, doing fairly well, along with managers like PSG, Coronation, and Camissa. If you look at the moderate and conservative portfolio options over the last 12 months, it's actually been one of the more conservative portfolios that's at the top. That's largely because South African bonds have done very well, and the SMM 30 portfolio holds a lot of South African bonds compared to, say, SMM 50. Over the last 3 years, it's been the absolute return fund of moderate absolute that's done well, far in excess of cash returns. So if you see the Sim Cash Fund, which has delivered a very credible 8.3, but this fund has delivered much higher than that. And over 5 years, again, it's been your moderate absolute return fund that's at the top of the pile that's done very well. And again, its target, for example, is inflation plus 5. And over the last 5 years, it's delivered close to inflation plus 10. That's not necessarily sustainable, but again, it's been a positive environment for members to operate in. Sally, I'm going to hand back to you for the protection strategies.
Thanks, Paul. So let's look at the protection strategies. As Paul mentioned earlier, there's a selection and choice between Sanlam Secure Strategy, which guarantees 100% of capital, so being invested in a monthly bonus fund, and also the Sanlam stable strategy, which also provide 100% capital guarantee. So the difference between the two portfolios is that while Sanlam secure strategy provides bonuses that are declared monthly, which are fully vested, Sanlam stable strategies bonuses consist of vested and also non-vested bonuses. So that's the difference. And also in terms of the capital guarantee charge there. The volatility protection strategy, it's predominantly focused on capital protection, but 25% is invested in the Cetrix Enhanced Balance Tracker, which is a growth portfolio to try and eke out some of the returns should markets run. So that's how the three protection strategies are differentiated. And this is suitable for members who want to maintain a single investment lifestyle, single consistent investment strategy throughout their retirement savings journey. So it has been a good period for for investment markets in general, and the strategies have participated in that. So if you look at the 1 year, very strong returns across the three strategies compared to inflation of 3.2%. Even when you look over the long term, so say over 10 years as well, the portfolios have delivered in excess of inflation. So this is important to ensure that member savings do keep up with inflation and also outperform inflation to make sure that in real terms, the value of their retirement savings is growing. So now let's move back to the life stage strategies. So all the life stage strategies have a single strategy towards retirement, which we term the preservation phase. They're invested, members close to retirement, especially 2 years within retirement, are invested in the capital protection portfolio. So this follows the 50 monthly switches from the accumulation phase portfolio. And after that, members will be 100% invested in the capital protection portfolio with the Sanlam stable bonus portfolio as the underlying portfolio. So it's worth mentioning that that portfolio aims to protect capital across all terms. So capital is protected on a monthly basis, and the portfolio has delivered on that. And this is due to the capital charge that members, capital guarantee charge that members pay to receive that protection. Additionally, the portfolio seeks to grow member savings in real terms, even within those last 2 years of retirement. And over the last year, the portfolio has delivered that, so delivering a real return of 8%. And notably, there was a low inflation environment, but over 3 years as well, the portfolio delivering real returns. And if you look at the portfolios, the way the portfolio declared bonuses compared to some of our competitors, so the Sanlam capital protection is illustrated by the blue line. I think you will note the smoothness of the line. So that speaks to the philosophy around how we declare bonuses. So we declare consistent bonuses that are predictable. So for example, in May, while some of our competitors have delivered negative bonuses, we did not deliver negative bonuses. And you can see that relative to the peers in the market, the blue line is smooth and also pointing upwards. And this is in line with the philosophy of how the portfolio is managed. And just in terms of why this portfolio is important for people close to retirement, so this portfolio does two things. It smoothes out volatility so that members close to retirement get returns that are less volatile and smooth. So there is a smoothing element, but also protects capital. Now let's take an example of two members, Soli and Dani, within the Sanlam umbrella fund, who are retiring just 1 year apart from each other. So if Soli retires at the end of March 2029, if Soli was in the blue line portfolio, which represents the Sanlam capital protection portfolio because it's smooth, and we compare that if Soli had been on the portfolio represented by the gray line, which is a normal market-linked portfolio, it wouldn't have mattered because at that time, investment markets were doing well. So both the blue line, which is the Sanlam capital protection portfolio, was doing well, and also average market-linked portfolio. Now, exactly 1 year later, let's look at Danny's situation. And it would have mattered whether Danny is in the blue line, which is capital protection portfolio, or the average balance fund or the market-linked fund. So if Danny was in the average market-linked fund, such as an accumulation portfolio, Danny would have experienced over that year capital losses. Whereas if Danny was invested in the capital protection portfolio, he would have enjoyed the capital guarantee afforded by the portfolio. So that's what we have in terms of the investment feedback. So just in concluding, I think at the beginning we showed that there is tough times ahead. The global trade policy and also other global factors being uncertain and also weighing up on South Africa. And in South Africa as well, we are having our own country-specific challenges. What I liked about the panel earlier is that, amongst this uncertainty, there are opportunities, and we have our investment managers that will help us source these investment opportunities. And you also heard, from Paul Wilson, when he said, in the long term, markets often go up more than they go down. And I think members of the Sanlam Umbrella Fund and also the participating employers, together with advisors, they can take comfort in the fact that there are default investment strategies that are appropriately designed to make sure that the investment strategies are relevant to members irrespective of where they are in their lives. And this is particularly important because most of the members do not make that member investment choice. And for those members that want to exercise that member investment choice, there is flexibility in terms of the investment options that they can select. So the members of the Sanlam Umbrella Fund can be rest assured that their money is managed appropriately. Just before I let everybody go, I would like to thank you for participating in this investment feedback. We really appreciate your feedback in terms of how can we improve in future sessions. And, to that end, please remember to fill in the questionnaire. That is a feedback questionnaire to help us always improve, to ensure that we deliver the message and also the feedback that is most appropriate to you. With that, I'd like to say enjoy the rest of the day and thank you very much.